Welcome to Retirement Optimizer's how-to videos to help you navigate the software and plan your retirement. This video will work through the inputs of Step 6, Corporate Accounts. If the retiree or their spouse does not have a corporate account generating passive income, you can continue to Step 7. If the retiree or their spouse has a corporate account, you must enter the fields for each separately. After clicking Yes, fields will appear. Note that they must all be filled in, and if there is no entry for a certain field, you can simply put a value of 0. First enter the client and spouse's percent ownership of the corporation and whether tax on split income applies. Tax on split income applies the highest marginal tax rate to applicable dividends in order to discourage income sprinkling. To find out if it will apply to the secondary shareholders' dividends, consult the flowchart found underneath the question. Because Canadian equity investments are treated differently for tax purposes than other investments, we must distinguish them in the account from the non-Canadian equity and fixed income assets. However, the inputs are similar for all three. Let's work through the Canadian equities for our example. First, enter the dollar value of the account's Canadian equity. Then enter the unrealized capital gain, which is the current value minus the adjusted cost basis. This is followed by the expected annual appreciation of equities expressed as a percentage, where growth excludes other distributions. Then enter the expected annual dividend yield of equities expressed as a percentage, followed by the distributed capital gains from the fund to the account, and not from buying or selling the fund. Then enter the return of capital distribution, which is the payment made to investors that returns part of their original investment rather than distributing profits or income earned by the investment. For the eligible refundable dividend tax on hand account, enter the current value of the notional account, and enter a 0 if this is unknown. If the client holds non-Canadian equities in their corporate account, you will have to enter the same inputs for these equities. Likewise, should there be fixed income assets in the corporate account, such as bonds or GICs. Then enter if the corporation is still earning an active business income, and if so, enter the pre-tax annual business profit, as well as the expected annual growth rate and how many years the corporation will continue to generate the active income. Should the corporation be earning passive income, for example, rental income from an owned building, you must enter the same fields as for the active income. Next, enter what percentage of the account will be bought and sold on an annual basis, realizing capital gains. Enter whether the client loaned money to the corporation, and if so, the value owed to the client and the value owed to the spouse, where shareholder loans can be paid back tax-free. Next, enter the current value in the non-eligible refundable dividend tax on hand account. This is a notional account that increases in value from interest income and non-eligible dividends flowing into the corporate account. If you don't know what the value is, enter 0. The software will calculate it going forward. Now enter the current value of the general rate income pool. This is active business income subject to the higher tax rate and eligible dividends from investments in Canadian equities. Now enter the current balance of the capital dividend account. It is a notional, non-cash account tracking the corporation's ability to pay capital dividends. It increases with realizing capital gains. If you do not know, enter 0 and it will be calculated by the program going forward. Next, enter the minimum dollar value of the capital dividend distribution. This is a minimum threshold set due to CDA costs. Now select if the corporation will maintain the same ratio of Canadian equities, non-Canadian equities, and fixed income assets. If you primarily own a mutual fund that has a fixed ratio between the different asset classes, make sure to select Yes. Enter if the client is going to be paying for a life insurance policy out of their corporate account, and if yes, enter the annual premiums and the amount of the payout at death. Next, enter if you'd like to exclude the corporate account from analysis. Next, select if the retiree has an individual pension plan, and if yes, enter the dollar value paid out of the IPP annually, the percentage growth of the IPP payout, and the value of the actuarial residual at the end of retirement. This completes the inputs for corporate accounts in Step 6 of the Solver. Join us in our other how-to videos, which detail further steps of the program.